It's a continuation of the series on the valuation formula used by PolarisInvesting.com. The first video in the playlist talked about the valuation formula itself. This and subsequent videos discusses specific inputs used in the formula. In this video, we'll be talking about the sales growth input. Sales growth is the most impactful input used in the valuation formula. And you see here what's currently being displayed is the formula, and then right above that is the calculation of future sales, and future sales is the current sales times the growth anticipated over the next 5 years. Now, as you look at the valuation formula, you can see that future sales is a prominent input. You take the future sales, you take it times the future profit margin, you get future earnings, and take that times future price earnings ratio, you get future market capitalization. Divide that by anticipated future shares, and you get a price per share. Discount that back at the cost of equity, add in the dividends that are received over the 5 years, and you get a valuation. As discussed in the first video of this series, the main reason you move forward in time is to get to price earnings ratio that you feel is totally mean reverted. And then once you are dealing with a mean reverted PE, it's straightforward to calculate the expected price earnings ratio. So the PE value is straightforward to calculate. The price or the profit margin is also fairly straightforward. It's, you look at the industry mean reverted profit margin and look at the company's current profit margin, make a decision as to whether it will totally mean revert to the industry or not. Future shares, you look at historical issuing of shares and build out an expectation of what future shares could be. Cost of equity uses a well-known method that's discussed in other videos and how to determine that. Dividends is something you look up. So it really leaves the future sales as the most uncertain input value in the valuation formula. And that's why when we look at the site, that's why the only input that's directly available for an end user is the sales growth input. Since this video was originally recorded, 2 other sliders have been added to the Polaris website, namely the future profit margin slider and the future price earnings multiple slider. A value add of the PolarisInvesting.com website dealing with sales growth is it does provide default value. You can see here in the case of Walgreens, it's showing a default sales growth of 5%. We'll be discussing in depth in this video where that default value comes from, but it does calculate one for the user, and then the user can override that easily by just moving the slider or sending it back to one of these values, default or the industry average sales growth, or for comparison the expected growth for the average growth expected for the companies that make up the or stocks that make up the S&P 500. Now, other values that go into the formula, namely profit margin, PE, future shares, cost of equity, and even the dividend, are shown here at the bottom of the ticker page. And you can indirectly change these through the sales growth slider, but that's discussed in other videos in this series. Before discussing how to determine a defensible sales growth value, I want to first discuss the significance of the magnitude of the sales growth forecast that you make with the slider. If you notice here, as you move the slider around anywhere below 15% or above minus 15%, as you move it, the change is only 1% at a time. Once you go above 15% and move the slider, then you'll notice that it's moving at 2%, and that's also true if you go below minus 15%. Then if you go above 30% or below minus 30%, you notice here as you move the slider, it changes at 3% each time. There's two reasons for why the increments change depending on the magnitude of the forecasted sales growth. First being is when you're up here at these high extreme growths, percentage change going from 39 to 40 is a very small percent increase, so it really doesn't have much impact. So it's best to move at larger chunks so that the percentage increases that you make each time you move the slider have more of an impact on the valuation. Now, when you're down in the single-digit range and you go from 5 to 6%, that's a pretty significant increase. So you want to be able to fine-tune growth when you're down talking about single digits growths. Second place where the magnitude of the sales growth slider comes into play has to do with the practical valuation and the practical investment return. And this is discussed in detail in a playlist out on the YouTube investing.com, PolarisInvesting.com YouTube channel. The playlist is called Concepts, and there's one that, specifically on practical valuation. When determining practical valuation, it's important to consider the tolerance that the marketplace will likely have in terms of its thinking about risk and future sales growth. The sales growth that's shown here for the market, namely for Walgreens, is minus 4%. Where that came from is just simply working backwards to the formula, assuming you know the value, other values besides future sales. You just plug in the current price, work backwards to determine what the implied growth is by virtue of the current price. Now, typically, the market has a different outlook on sales growth, as again determined by working backward through the formula, and then what the theoretical valuation, which is determined by where you move the slider. Practical valuation is an attempt to consider how much the market might be willing to move towards the theoretical valuation in terms of, and that's determined by how much flexibility is likely to have in terms of moving towards the theoretical valuation, and that's in terms of sales growth. How much is it willing to change its opinion about a -4 sales growth that gets closer to the theoretical sales growth of 5%? Well, there's only so much tolerance there, and what dictates how much tolerance or how much the market would be willing to move is the magnitude of the selected sales growth. So as you, the user, move the sales growth slider around, and assuming that this, after a lot of careful analysis, that you determine some growth rate that you think is valid for the company, the magnitude of that growth rate is really setting kind of the ballpark in terms of what likely sales growth is going to be. Now, that's a lot different than just working backwards and calculating an implied sales growth. There's really no thinking that is assumed by the marketplace. It's just a number. But here, when you set the value as an end user, you just assume that it was given a lot of thought, and therefore it's more setting the likely ballpark range for growth. And the magnitude is setting how much change you think the market would likely be willing to go through based on your careful analysis. So when you move the slider up into higher values, we're assuming that the market's going to be more willing to change because there's a lot more, wiggle room, you can call it, when you're moving things around at this high, 3% at a time at this high growth rate. But now you're down in the single digits, it's likely that the market is not going to be willing to change its opinion about sales growth quite as much. Now, a question that comes up is if you, the user, are assuming some high growth rate, for instance, and here we are looking at an implied growth of -4%. Is why such a huge difference? Why do you, the user, feel like the proper ballpark range is more like in this double-digit range, but the market seems to think that's only single-digit and negative? Well, this implies that the market must be factoring in other things besides just sales growth and the riskiness of future cash flows. And what those other things are, who knows? You just don't know. So really what this is saying is that this number alone doesn't totally factor in all that the market's considering. Therefore, it's not really a number that you should use to directly compare to what your forecasted growth rates are. But you do use the magnitude to use to determine how much flexibility the market would have around adjusting its opinion about sales growth. All right, let's get back to the sales growth slider. And you can see here, it's very easy for you to move the sales growth slider around and do what-if analysis to restore it back to default value. Try out what you think what the theoretical value would be if you assume the industry standard growth rate or even the average growth for the S&P 500 stocks. I want to go back and focus in on this value, the default value that Polaris investing calculates, and want to determine exactly how that's being calculated. Well, Polaris uses two different approaches in calculating that default value, and the one approach versus the other is based on the operations type. And there's a separate video out there on operations type that I invite you to go watch. But here, showing the tooltip. Just a quick reminder, basically it boils down to operation type means whether future operations are considered going to be quite different than current operations. And if a company is viewed to have consistent operations going forward, then it's classified as having stable operations. But if future operations are going to be much different than current operations, then it's considered dynamic operations. So, for example, I want to talk about when we have stable operations and how default sales growth is calculated. For a company that's considered to have stable operations, the default sales growth is determined by looking at the consensus analyst forecasts for earnings, and then using profit margins converts that to an equivalent sales growth. Also, it takes the analyst forecasts and runs it through an operation called dampening, which kind of taps the brakes a little bit on the forecast from these analysts, because analysts tend to be overly optimistic, particularly sell-side analysts, and almost all the forecasts, earnings forecasts that you see out there on websites that are free, are from sell-side analysts who are essentially in a sell mode, trying to convince you to buy the stock. So you really need to temper that enthusiasm they have for their stocks that they're covering, and dampen down their forecast a little bit. Now, that dampening is done by looking at historical capital requirements for growth, and if the forecasted growth is out of line with historical capital requirements, and then it'll bring the sales forecast down to align with anticipated capital investments going forward. So let's take an example of going out to CNN and looking at, for Walgreens, what we see out there in the forecast tab. So we scroll down and we look at the earnings forecast, and you can see here as we scroll down that there's 27 different analysts being pulled in making up this forecast here. And actually you can see an earnings and also a sales forecast here for on the CNN site. So it's using 4.32%. We go back and compare that to what the default value is coming out of Polaris, it's close, but it's different. And the main reason is that Polaris uses a different set of analysts than CNN. Now, when we go back and look at the CNN site, let's don't forget that this number, average number of 4.32%, came from 27 different analysts. And if you scroll up here, you look at the valuations that those different analysts came up with. The range is quite the range, from a low of 62 to a high of 95. So you want to make sure you don't get too caught up in somehow this average number being something that has more accuracy to it. It's just an average, and it's an average across a lot of analysts, typically. Like I said here, we're doing 27 different, and depending if you use the high or the low, you can end up with quite a different valuation. So you've got to give a lot of thought to really what you think is an appropriate forecast for sales, and use this as just one of many inputs that you consider when coming up with your forecasted sales growth. Let's go next and talk about the other approach that Polaris uses in setting this default sales growth, and that is if the operations type is considered dynamic, or future operations are expected to be quite different than current operations. In this case, what Polaris does is it determines future sales by extrapolating from a recent trend in sales. Now, at first it seems a little inconsistent to base future sales on a recent sales trend when you expect the future operations to be much different than current operations. Well, it's assumed that recent sales trend captures the inflection point of current sales outlook. So let's look at what we're talking about here with the different types of extrapolation that are typically used, and that is either a linear, exponential, or logarithmic. But if you're back here in history and you're looking at a particular recent period of time, and let's keep it simple, you're using linear extrapolation, which is using this familiar formula for a straight line. And Polaris will do a best fit and then project forward in time what that likely future sales will be. But it is assumed that this historical data is recent enough that it's catching the current outlook. Now, sometimes this isn't true, and you end up with a potential value trap, in that the historical data that you're using to best fit to, in this case, if we're doing linear extrapolation to a straight line, if it's too far back in time, or if the outlook for the company is just very recently changed, then that historical data doesn't reflect the current outlook for the company, and then you end up with a line going forward that's not representative of the true outlook of the company. So you really need to go back and look at the historical data and think through the current outlook and make sure that the two are aligned. Now, there's other extrapolation methods, exponential, which is the green line, which starts off a little flatter, but then it goes up quite a bit as time goes on. And the formula for it maybe isn't quite as familiar to most people, but it's similar in format to the linear extrapolation. And then the third type is logarithmic, which is the red line. Things go up quickly, then level off. And then here's the equation itself, which is formatted similarly to the linear and exponential. Now, the main extrapolation technique used by Polaris in most situations is exponential. The reason that exponential is used most often is this is an attempt to be positive about these dynamic companies, that the data reflects that hopefully that the things are improving, but even if they're not, the formula will not be quite as extreme in terms of turning upwards. But overall, it's just trying to be more positive about the outlook for the company, and therefore exponential extrapolation is the default. Okay, once the extrapolated sales 5 years out is determined, it's then combined with the future sales implied by the growth from the market. So if you go back here, -4% for Walgreens, and we look at the formula, you can calculate a future sales based on that. So we have two different sales. We have one sales that's based on the extrapolation 5 years out, and another sales that's implied through the from the current price. So they're combined. And the way that they're combined is just simply a 60-40. 60% of future sales is derived from extrapolated sales, and 40% of future sales is derived from the implied future sales from the current market price. Now, the reason for the split of 60-40 is that it's assumed that the extrapolated sales is somewhat more reliable, it's objective, a rational way to arrive at future sales. And you compare that to the implied future sales from the price is more of a felt to be subjective and probably driven in the short term by emotion. So I want to put a little more credibility on the rational extrapolation. But because it is based on recent historical trend and some of the issues that can come up when the recent outlook has changed or current outlook has changed from the recent data, you don't want to overweight it beyond 60-40. And the other reason is that any kind of extreme weighting of the extrapolated results causes the theoretical valuation to just further diverge from the current price. And any extreme divergence of the theoretical price from the current price, this results in a practical valuation that is closer to the price, because as discussed in the practical valuation video, the market only has so much tolerance for change at any given time, and therefore extreme weighting of an extrapolated sales that's possibly quite different than the implied sales growth from the current price really is not going to change the practical valuation much. And this is a quick reminder of that. Is here we're looking at what's shown in the practical valuation video. But if you've got a price, let's say, of $53.75, and your theoretical valuation is based on too aggressive of a sales growth, you just end up with a big spread between the current price and the theoretical valuation, and you're only going to get so much tolerance from the market in terms of how much you can expect the price to maybe move towards your theoretical valuation. So once this gap starts to grow larger and larger as a result of bigger and bigger sales forecasts being assumed in your theoretical calculation, you're just going to end up with the same practical valuation. So it really doesn't impact what you're really making your decisions off of, which is the practical valuation once you're have too extreme of a future sales growth being used in the theoretical calculation of the valuation. All right, so let's move towards how you would come up with a defensible value for sales growth that may be different than as opposed to just taking the default sales growth or using an industry standard sales growth. Well, when I do it, first thing I look at is the difference between the industry sales growth and the default sales growth. And here you see for Walgreens, we see quite a difference. So if you scroll down to the bottom of the ticker page, you see what industry that Walgreens is considered to be part of. So I would then want to go off and start looking closer as to why there's such a difference in between the default for retailers, drugs, and Walgreens. So I look at some of its competitors like CVS and other competitors that I would learn about as I study the company more. Look into the industry, what's going on, what are some of the secular trends going on within the industry, and just try to come up with reasons for why that this sales growth would be default sales growth would be so different. If I discover that maybe again it's more has to do with the historical data that was used to calculate the default, and then I would maybe think about moving it up closer to the industry sales growth, or even beyond it, based on my analysis. All right, after looking at and comparing the default to the industry, then I typically scroll down here to the sales growth graph, and going to hide the practical and the S&P 500 lines, and you can see here as I move the slider around, it's really impacting the sales growth of or the valuation of the in the future sales of the theoretical valuation. So anyway, you look at where the sales is starting off as. This is the current sales, so it's 131 billion for Walgreens, and you need to think through whether that's a representative number or not. What's often referred to is that normalized earnings. Often you'll find out that current sales are reflective of some type of one-time event, like a merger, some resolved litigation, even possibly as you look into the company, you see indications of opaque accounting, recognizing earnings way too early, channel stuffing where, the company's counting as revenue product that's actually in the distribution channel and actually hasn't been purchased by end users. Sometimes you'll see evidence of customer rebates not being properly accounted for, namely that the revenue number includes the rebate, and then down further in the income statement you see expenses for customer rebates, and that's an inappropriate way to show that kind of thing. That should be netted out in the top line revenue number. Now, opaque accounting is not as big an issue for larger companies that have, well-known auditing companies, but for smaller companies, they just have less eyes on their accounting and more prone to these kind of accounting gimmicks. Now, starting sales is important because it determines where you end up in terms of, in case of Walgreens, we end up 5 years out, 167 billion. Well, the reason is because we're applying a 5% growth rate. So we apply it against a starting sales of 131, but if that 131 billion is not normalized, then where we end up at is not an appropriate number. So another approach that you can take is you can start with the end in mind, namely come up with some assessment of where you think sales will be in 5 years, and then do the math that's here. Let me show you the math that's involved. Is just simply, if you know the future sales, take the current sales, and then you determine what the growth must be to get you from current sales to your expected future sales, and then you just set the slider over here to that value. Now, a question comes up is, well, how do you determine ending sales if you don't base it on some sales growth and just apply it to beginning sales? How do you just start off with a value, or how do you think through what the ending sales could be? Well, one approach I'm going to show you is using an example of Uber. And here's a full valuation of Uber. But what's interesting about it is the first line item represents the overall market that this analyst felt that was referred to as addressable market. So you can see here year over year that the addressable market is being shown. And then the next second line is showing what the analyst felt that Uber could actually capture from the growing overall market. So here 5 years out you would have a revenue number, because you just take the addressable market times what the market share is expected to be, and then get a revenue number 5 years out. Now there's issues with this approach. One is that the individual that shared this valuation told a story of showing this valuation to an executive at Uber, and the executive immediately took exception to the overall market that the analyst was using. And when they looked into it further, the executive said, well, our addressable market is not just ride sharing. We also plan on using our infrastructure to for last mile delivery of goods from retailers. And if you consider that, and they start getting into the UPS, FedEx kind of market, it opens up a much larger addressable market. So you got to have a clear understanding of what is the addressable market and what the likely market share is. Now, for market share, if it's more a company that's been around a while, you can look at a historical market share and use that going forward, or at least a trend of market share going forward. But for newer companies like Uber, Netflix, things like that, even deciding what percent market share could be a little difficult. But it is an interesting approach that you could at least try to use to get an idea of what future sales might be for a company. Another approach to determine value for the sales growth slider is to do something similar that was done for the dynamic company when Polaris is calculating the default value, and that namely is to extrapolate, decide on what method you want to extrapolate, what kind of historical data you want to reference in order to build out the extrapolation. And really, this is best for companies that you feel like you have some unique insight into. It gives you a better feel for really, what is the appropriate historical data to take into account, and then really what kind of future growth growth trend you're going to see going forward. One last thing I want to mention is let's don't forget that Power of the Site is doing what if analysis, is moving the slider around, seeing how it impacts the theoretical valuation, and then the resulting practical valuation and practical investment return you get from that. And recall as you move the slider around, as you get into really higher and higher ranges of growth, you're really not impacting the practical valuation, because the theoretical valuation is becoming just so different than the current price. It's just not realistic, practical to think that the market's going to be willing to change its opinion that drastically in order to get up to your extreme growths that are built into theoretical valuation. So you end up with not having to consider a lot of different sales growth ranges. You just pick out a few, and then eventually you're going to hit a limit on how much the market's going to be willing to change, and then you end up with a range to consider and make your future buy-sell decisions on. All right, this has been a discussion of sales growth, the input into the valuation, and things you should consider when setting the sales growth slider. Thanks for watching.